Hey Legacy Traders, it's Tim Key with Option Legacy, helping you build a legacy through trading. So guys, you asked, I answered, you said, Tim, we want to know more about individual option strategies. So perfect, I've got a real popular one for you today. It's called the Bear Call Spread. Bear Call Spread. It's also known in some other circles as a vertical call spread or a vertical credit spread. However, we're going to call it a bear call spread, as I believe that's the most easy way to remember it. So I teach in my legacy trading course some of the fundamentals, and one of the easy ways that I found out or began remembering what is bullish and what is bearish, I think of a bull and it's got horns, right? And it goes and it hooks up. So a bull horn hooks up, so a bullish stock means it's going up. But then you think about a bear, it's standing on its back two legs, roar, and it's attacking you, and it has a bear paw that swipes down. So whenever a stock or a security is bearish, it's going to the downside. So we can put on this trade a bear call credit spread, and guys, we can get paid to trade, and we put this on whenever we have a directionally bias, meaning that we think that it's going to move in a certain direction. In this case, to the downside, become bearish. So let's pop into the good stuff and get this party started. So our bear call credit spread by Option Legacy. When do we enter into this thing? The bear call credit spread is entered when the option trader, that's us, thinks the underlying stock will fall moderately in the short term. So how do we set this thing up? The bear call spread can be set up by selling one out the money option while buying one further out the money option of the same stock at the same expiration date. So we sell one out the money option. It's at a higher value because it's closer to the money, but it's still out of the money. And then we buy something that's further out of the money. It has a lower value. So we sell something of higher value, hedge ourselves by buying something of lower value. That creates a credit, or the difference there is that credit spread. That's where the credit spread comes into. So what is the risk? The max loss in the strategy is defined, which is absolutely beautiful, especially for beginner traders. From the moment that you enter into this trade, evaluate and enter, your max loss is defined. You know exactly what that worst case scenario is going to be. Versus something like maybe a straddle or a strangle, where it's a naked position or just a naked call or put, where we sell something without being hedged. That is an undefined risk position, and that can be dangerous for new traders because one false move and you could blow your whole portfolio up real quick. So this is great because it's max loss it's a defined loss strategy, and the risk here is the difference between the strikes minus the credit you receive. So the max loss in this trade happens when the stock closes the amount of credit you received above your short strike. So remember, it's a bear call spread. We want this thing to move down. Bear, paw, attacking, bear call spread. We want this thing to move down. So the max loss happens whenever this thing moves up above the amount of the stock and the credit received of your short strike. The max gain on this trade happens when the stock closes below. Again, we want the thing to move down, so when it closes below the price of your short strike. At expiration, you will receive your max credit. So what are the break-even points? The break-even point is the short strike plus the credit you receive. And don't worry, I'm going to give you a visual on a chart, break this thing down for you even more, but let's carry on. So here's an example. The stock's trading at 265. This is a real example on the chart that I'm about to share with you. We have a directional bias. We think that the thing is going to move down, move to the downside, become bearish. So we could sell a 271 call for a credit of $200. And then we could buy a further out the money call at the 276 strike, and that would take in that would be cause a debit of $50. So $200 minus $50 equals a net credit of $150. So the max loss here is the difference between strikes. In this example, it's a $5 wide difference. 271 and 276 is $5 wide difference minus the credit that you received, which is $150. That equals a $350 max loss here, predefined. Then the max profit is simply the credit that you received. So that net credit that you received of $150, that's the max that you can get. So let's go and look at a chart and put this thing out for you guys. So this is the SPY. I like to use it. It's a popular ETF. It's obviously, if you don't know, it's the ETF for the S&P 500. So you can see right here. This is TradingView. It's a free charting software. We'll put a link for it down in the description of the video below. But this is what a bear call spread would look at. We say, hey, we think that this thing is going to continue to move to the downside or continue to become bearish. So we would sell an out the money call at this 271 strike price, and then we could go 5 strikes above and buy to open a 276 call, and we would do that for a $1.50 credit or $150 credit. And so now let's see if we can't zoom in. We need this thing at expiration. Oops, so this is the free version. So it will have ads. We need this thing at expiration, anytime between the time that we open to at expiration, to continue to stay below our short strikes plus the credit that we received. So our short strike is 271 plus $1.50 credit. That's 272.50. At this point, anytime between the time that we enter an exit or the time that we enter an expiration, we want the underlying security to be below the short strike minus the credit, or short strike plus the credit we received. If that happens, if it closes anywhere below 272.50 at expiration, we will make a profit. Our max profit is had whenever this thing at expiration closes below our short strike. So if it closes anywhere below the 271 short call strike there at expiration, our max profit, which you can just imagine little dollar signs, your account going up, will happen. However, if at expiration, if it's anywhere above the short strike plus the credit of $1.50 that we received, then the max loss begins to happen and sets in, and we are at a loss. So you can see that obviously we need this thing to move to the downside. We sell something that's closer to the money, the price of the underlying stock. We sell something closer to the money, take in a higher credit, and then we hedge ourselves to create a defined risk trade or a credit spread, and that's something that's further out the money at a lower price, and we get to keep that difference in between if this stock trades to the downside. So guys, that is a bear call spread. Of course, if this video added value to you, please subscribe, share this video, comment, let me know your thoughts, and then also please feel free to join our free community over inside Facebook, Legacy Trading Group. I'll put a link below in the description. It's absolutely free, where you can be surrounded by a community of other traders. I believe that if you can partner transparency inside a community, you'll naturally have growth. All right guys, can't wait to see you on the other side. Happy trading. Let's build that legacy.